Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. Welcome to another edition of our weekly podcast. Global equities recovered later in the week on region-specific developments. In US, major benchmark indices remained under pressure earlier in the week as the US Fed pushed back on rate cut expectations. However, Dow Jones and the S&P 500 index touched new all-time highs on Friday after US hiring and unemployment data revealed underlying strength of the economy. Asian markets also rose, led by Korean markets, which rallied over 5% amid news of Korean officials collaborating on the Value Up program to address the valuation discount in Korean equities, while the Hong Kong and China A shares remained under pressure for the week. Back home, Indian equities rebounded after two consecutive weeks of consolidation. The Nifty index rose 2.3%, the highest since December, driven by upbeat earnings reported during the week and growth-supportive budget announcement. Broader markets performance remained strong, with the Nifty Mid-Cap Index up 2.7%, while the Nifty Small-Cap Index was up 5.6% for the week. Among sectors, energy and utilities led the winners with gains of over 6.8%, while capital goods and telecom led the losers with cuts of around 1.5%. The Indian fixed income market had one of the best weeks in the recent past. Indian government bond yields declined across the curve, supported by a decline in US bond yields and the news of lower than expected fiscal deficit target and lower government borrowing proposed in the fiscal budget for fiscal year 2025. The 10-year Indian government bond yield fell 12 basis points to close at 7.06%, while the 3-year and 5-year Indian government bond yields fell 7 basis points each. The INR rose 0.2% over the past week to close at 82.93 per dollar amid falling US bond yields, lower crude oil prices, and a weakening US dollar. Brent crude oil prices fell after a stronger than expected US jobs data lowered the odds of an imminent rate cuts in the US, weak economic data from China, and the possibility of some easing of tensions in the Middle East. Among the macro updates for the week, the first was on India's manufacturing PMI, which rose to 56.5 in January 2024, higher than December's reading of 54.9. This was also the strongest growth in the factory sector since last September, as both output and new orders expanded the most in past 4 months, while new export orders also rose. Employment was unchanged amid a moderate accumulation in outstanding business. On the cost front, input price inflation hit a 3-month peak despite being a moderate rise and among the weakest in over 3 years. The second data was on India's fiscal deficit, which for the period of April to December widened to INR 9.8 trillion or 55% of the fiscal year 2024 budgeted targets. This was lower than a 59.8% deficit recorded in the same period last fiscal. Total spending stood at INR 30.5 trillion or 67.8% of the budgeted estimates, while total receipts stood at INR 20.7 trillion or 76.3% of budgeted estimates. Third data was on India's Union Budget announcement for fiscal year 2025. Key highlights include: first, thrust on investment continues, with fiscal year 2025 capital expenditure forecasted to increase by a 17% to a record INR 11.1 trillion, which is equivalent to 3.4% of GDP, with higher outlays provided for housing, agriculture, renewable energy, roads and railways. Second, government sticks to the fiscal consolidation path. The government set fiscal year 2025 budget deficit at 5.1% of GDP compared to a revised 5.8% of GDP for the fiscal year 2024. Further, both fiscal deficit and government financing requirement was lower than market expectations. Third, no major changes in taxation. The budget retained the extant direct and indirect taxes, including import duties. However, certain tax exemptions for startups and IFSC units, which are expiring in the current fiscal, were proposed to be extended to fiscal year 2025. At this point, I'll take a pause and thank you as always for listening. If you enjoyed the podcast, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, Reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.